All right, let's go ahead and get started. Again, my name is Jason Maida, in case you missed my introduction here a couple minutes ago. So my name, we're a partner with UC Riverside. And so that's why you heard about today's workshop. And we're really excited to be able to share this information with you. Again, this is a very interactive type workshop. So as I go through tonight's content, feel free to use the chat function in Zoom. And what I'll do is I'll answer some of those questions on air. So a little bit about me. So I'm a branch manager with American Pacific Mortgage, but I also, beyond facilitating classes like this once a week, I get a chance to work one-on-one with clients and help really designing their home buying plans for them. So that's what I love doing. Get a chance to really help clients realize home ownership. And we specialize in first-time buyer programs. So, we're based out of Northern California, but we lend in multiple states, including all across California, especially with some of the CalHFA assistance programs that you're going to learn a little bit about tonight. Let's talk about our talking points for this evening. So we're going to spend some time looking at the housing market, kind of see what trends look like, as well as interest rates. We're also then going to move into budgeting, kind of talk a little bit about what's it going to look like if I had to go from renting versus what it could look like to owning a home. And then I want to spend some time looking at credit. We're going to give you some tips on credit and different resources to take advantage of. Talk a little bit about student loans and how they can possibly impact your qualifying. We'll look at different loan programs, some of the documentation that you'll need in home buying. We'll talk a little bit about assistance programs and some of the opportunities, especially in the state of California, that are available to you to take advantage of. And then we'll wrap up tonight's discussion looking at the process of buying a house. So I'm kind of excited about some of the things I'm learning this evening. Then if I want to take those next steps in home ownership, we're going to show you what the process looks like to go from attending a class, get pre-approved, all the way to getting the keys to my house. So a lot of cool stuff there. And then we'll wrap up tonight's discussion looking a little bit more about what is a consultation. So if I decide, I want to kind of sit down and map out a plan here for home ownership, what are we going to cover? What will that conversation look like? Okay, so let's first of all talk about what it looks like when I buy a home. What are the benefits for buying a home? Now, this is probably going to be one of the biggest purchases you make in your upcoming financial futures. Taking the time out on your busy schedule on a Wednesday or Thursday, I should say, it's not easy to carve out that hour or so to be able to kind of, hear more about home ownership, but it's important. So those are important investments you're going to make for successful navigation of this kind of situation in home ownership. And the benefits that come along with owning a home, obviously affordability is a big deal. Being able to say, hey, I no longer want to rent anymore. I don't want to have to worry about, how much my landlord's going to increase my rent. I want to kind of control my own destiny from that perspective. There's the ability to have equity accrue in my home. So as I pay down my balance and my home goes up in value, the difference between the balance and the market value is home equity. And this is an asset. So this is something that hopefully will appreciate. So you could potentially pass along this asset to the heirs of your estate. And finally, believe it or not, there's still some tax benefits that come along with owning a home. Even though there were some tax changes back in 2018, you can still potentially get tax benefits of owning a home. Now, I think one of probably the best places to start when it comes to kind of understanding more about homeownership, I think we first need to start with what does a budget look like for me? So we're going to now kind of transition into looking at a budgeting calculator. So what I'm going to do is kind of screen share with you a calculator here, and it's brought to us by Freddie Mac. And what this calculator does is it kind of shows us if we were continued down the path of renting, what might that look like differently if I was to own a home? So I'm going to walk you guys through this calculator this evening. Now, by the way, I forgot to mention all of the material from tonight's class is going to be sent to you via email. So we should have your emails on file. We'll send all that information for you. If you like what you heard this evening, all of the recorded version of tonight's class will be posted on our YouTube channel. They can check that out at any time. Again, we teach these classes about once a week throughout the year for our different partners across the country. So if you like what you're hearing, you can share this information, the recorded version, with a friend, family, maybe a colleague, or even have them attend a live class. So let's talk about this calculator. And we have kind of a scenario built out here. And what we're going to do is we're going to look at renting versus buying, right? So let's assume I have a $2,500 a month rent. So we'll have that in the rental column. We're going to assume monthly renter's insurance of about $15 per month. Let's also assume that our rent's going to go up about 3% per year. Now, I know many of us joining tonight's class have had rents go up, 7, 8, maybe even 10% on an annualized basis, but we're going to assume 3% for tonight's discussion. And then under the home purchase tab, we put $500,000 as our purchase price. The minimum down payment for a $500,000 purchase is 3%. So that's for a conventional loan. We're going to talk about loan programs in just a second. We assume property taxes of about 1.25% of the purchase price. That's what you should assume, or as a dollar figure, $6,250. We have homeowners insurance. That's going to protect our home against perils like maybe vandalism, maybe a flood if you elect that type of coverage. Of course, fire. By the way, as a side note, in case you haven't heard, homeowners insurance is quite expensive in California right now, primarily because there's limited carriers out there. And, we have some significant fire zones in California. So as you'll see at some point when you decide to take the next steps in homeowners process, homeowners insurance can be a little bit more expensive and very few options. Maintenance costs, we're going to budget at $1,000 for our home. Now, when we think about loan information, we're going to put a 30-year fixed mortgage in here. We're making the assumption of our interest rate being about 7.1. We're going to talk about interest rates in just a bit. Origination charge. So what origination charge is, that's the cost that you're going to pay for your lending options. And one of the great things in our partnership with UC Riverside is we offer a discounted origination charge. So normally there's a $910 processing fee. We drop that down to $160 as a benefit of UC Riverside. And then there's discount points. Now, discount points can be something that's offered by a lender to, in essence, bring down your interest rate. So that's something you can elect to do, but it's not just a standard process. Usually, the break-even point when you pay discount points is about 3 to 4 years. So here's how a discount point works. So if I have a rate today of 7.1, but I really want an interest rate of, say, 6.75, because that really gets my monthly budget in line, I can elect to pay points to help bring down that interest rate. Now, 1 point is going to be the equivalent of 1% of my loan amount, and that generally translates to a 0.25% reduction in rate. So that 1%, so if I'm financing $400,000, that's $4,000 that will get added into my out-of-pocket expense. Of course, the trade-off is what will bring down my interest rate, but I'll be expected to have more money out of pocket. So we had a question that came in the chat, just want to answer it, which is, what are some of the pros and cons for putting more into the down payment? Will it affect the interest rate? So we're going to spend some time talking about interest rates in just a few minutes, because interest rates are affected by down payment. I think the takeaway in terms of down payment will be that we have to figure out what your monthly budget's going to be and how much funds you have access to, right? Because not everybody has an endless supply of down payment. So some of our clients can just put a minimal amount of 3% or maybe 3.5%. But we got to figure out how that kind of translates to the budget of the home that we're looking to purchase. But we're going to talk about interest rates, how they're impacted by the level of down payment in just a few minutes. So let's kind of get back to the calculator here. So other settlement services are going to be closing costs through like title and escrow services. Some of the charges, they're government charges like transfer taxes, recording costs. Those will be all under other settlement services. When we think about closing costs, they're going to be generally estimated at 2 to 3% of your sales price. So when I step back for a second and think about savings, I got to save for my down payment, but I also got to save for my closing costs. All right, the last assumptions we're going to make is the appreciation rate of my home. So is my home going to go up in value, or is it going to depreciate? For this discussion, we're going to assume a 3% appreciation rate, which is pretty normal. Sometimes appreciation rates are higher depending on what the housing market's doing. Believe it or not, home values are still going up in most markets just because of a kind of a shortage in inventory. We're going to talk about that in just a bit. We're going to assume that we're going to be in the home 7 years. Now, the cost of selling my home, I think it's important for us to understand as buyers, when we have representation from a realtor, those commissions earned by the realtor are paid for by the seller, not paid for by the buyer. So we always encourage you to utilize those resources. But when I turn around and sell that home in 7 years, I'm going to be responsible for paying cost, not only to the realtor that sells my home, but the realtor that's representing the buyer of my home. Okay. And we project that at roughly 10%, including closing costs. We have our tax rate for California as well as the federal tax rate. We put the savings rate at 1%. I do realize savings rates are a lot higher right now. I think you can get 3 to 5% savings rates because of what's going on with inflation and the federal funds rate, but we left this at 1% for today's discussion. So when we look at this calculator, first of all, we know the monthly payment's going to jump up, right? So we're at $2,500 a month in rent. Now our mortgage payment's going to be closer to $4,400 a month. So there's a bit of a trade-off there, right? But I would encourage you to, when you think about homeowners insurance, it can't be like an apples to apples comparison. We have to take into consideration things like appreciation, tax savings. All of those things are super important. And of course, having home ownership, right? Owning something, being okay to, make some adjustments to my home or hang up that picture that I couldn't hang up in my rental, right? All those things are super important with home ownership. And so the opportunity in this scenario here, if I was to continue renting over 7 years versus buying over 7 years, is about $23,000. Now, as interest rates come down, perhaps that opportunity is going to be much better. If you're someone that's thinking about buying in the near term in this current rate environment, there's still some great opportunities out there. I always kind of encourage our clients to think a little bit more about interest rates, that today's mortgage that you receive is probably not going to be the same mortgage that you have 3 or 4 years from now, because markets will fluctuate. And it's at some point we will potentially have the opportunity maybe to refinance our home. And that gives us the ability to bring down that interest rate. So those are opportunities also that come along with owning a home. So again, that was the Freddie Mac rent versus buy calculator. And in case you guys didn't hear it earlier, all the material that we share this evening, we're going to go ahead and send that back out to you via email. Also, we'll have it live as our recorded version on our YouTube channel. Now let's switch gears a little bit. Let's talk a little bit about the housing market. As you heard me mention earlier, the housing prices are still kind of going up, but in this example, we see a little bit of a flattening here. There is projections showing the housing market's actually going to go up next year, even in this environment, which is hard to believe. But why are we in that place? Well, let's talk about inventory. Right now, there's just a lack of inventory to support buyer demand, even in a 7% interest rate environment. Because when we think about the housing market, we have limited supply, but we have high demand. So that's really stabilizing prices. So you're not seeing that decrease in prices. In fact, I talked to a client about 10 minutes before tonight's class, and they were saying, hey, I'm going to wait for prices to come down. I don't think that's going to happen probably anytime soon, given just the lack of inventory we have. Now, if interest rates start to go even lower, then we're going to probably see more buyer demand out there, and we are going to have an issue in what's available to buyers. As you'll probably see in your local communities, builders are building homes, but they don't not necessarily want to build a mass amount of homes, because if they can't sell those homes, they're carrying that inventory, and that's obviously expensive for a builder. So many times you're seeing builders build 10 to 12 months out for a buyer after they've secured a lot. So let's talk about this slide here. So the average price, and we're going to kind of zero in on Riverside County since we're doing a UCR workshop. So this is kind of a snapshot of the last 12 months in the housing market in Riverside. So you're seeing a little bit of a flattening here. Prices, or median price about 600,000. Days on market, 29 days. Probably really lines up fairly similar to LA and Orange County and all those markets in Southern California. So, and really it kind of lines up with what's going across the country. And right now, we just don't have the inventory because many owners just don't want to sell their 2.5% rate mortgage in exchange for maybe a 6.5 or 7% loan, even though they're sitting on this equity. Now that's going to change over time. It just will, because buyers need to change because of job relocation, or just really want to upgrade their home, or maybe there's a distressed sales situation. So markets will cycle out. Just at this point, we have a little bit of a challenge when it comes to available homes for our buyers. Now, we've talked a little bit about interest rates, and we're going to dive a little deeper with what makes up an interest rate, but let's look at historical trends here. Average interest rate is represented, or not average, but the trends in interest rates are represented by this blue line. This is the 30-year fixed mortgage. Average interest rate is now probably moving closer to 7.6 as of today. What's fueling that? Well, many of you probably know that it's just we're in a high inflationary environment, right? The Federal Reserve has ratcheted up the federal funds rate to combat inflation. And, it's really a day-by-day situation with different headlines that are moving the interest rate market. The latest thing that we've seen is that, potential liquidity challenges for banks. So that's kind of making its way to the headlines. And so we're trying to really see what's going to happen with any type of continued escalation of interest rates. Friday will be a big day because the federal chairs are meeting in Jackson Hole, Wyoming, deciding and going to make some more announcements on monetary policy. We may not see the federal funds rate move next month. I think there's right now a 10% chance the rate comes up in the month of September when the Federal Reserve meets again. But it's a very fluid situation right now, remains super volatile from an interest rate perspective. But, I was commenting on this the other day is that, when you think about interest rates, when we start getting to that next level of interest rates, so now we've hit the 7% level, there is kind of a mindset shift for the consumer. So hopefully we can get at least below the 7% level and maybe stay in the 6.75 or lower range, of course. But that'll be kind of the next level we need to get underneath. And most importantly, to create the best affordability for buyers. So we had the question in the chat about, what makes up an interest rate. So I think this slide really kind of depicts that, and I'll kind of dive a little deeper here. So credit eligibility makes up interest rate. So usually if I'm at a 740 credit score or higher, I'm going to have the best available interest rates. My product that I'm going to elect is going to influence the interest rate. So whether it's an FHA loan or a conventional loan, the amount that I finance will impact that. So if I'm over a certain loan amount threshold, that will help potentially improve my interest rate. How much I put down, and I think that's the question we had in the chat. So usually the down payments are tiered as 3% down, 5, 10, 15, 20, of course, then down to 25 and 30%. Now, if I put 3% down versus 10%, I'm going to have probably a higher interest rate or more cost on 3% because it would be perceived as higher risk versus someone that's putting maybe 10% or maybe 20% down for a loan. And then we talked about it earlier, costs through discount points. I can buy down my interest rate further. That can help improve my interest rate. And then the term of my loan that I elect can also help improve my interest rate. So if I went from, let's say, a 30-year fixed mortgage down to maybe 20 or 15-year mortgage, generally that would help bring down our interest rates. Now, right now, short-term rates are almost on par with long-term rates, so it doesn't necessarily make sense to drop to those lower terms. With all that said, though, most first-time buyers are going to elect a 30-year fixed option. But it's really kind of most important for us to design options that are going to make the most sense for you. And that's why we do those one-on-one consultations that you're going to hear a little bit hear about a little bit later on in tonight's class. Now, let's talk a little bit about credit. And there's usually, well, not usually, there is two challenges really, I think, to home ownership for first-time buyers, especially. One is it could be just down payment resources. I'm just trying to get my financial footing. I don't have enough saved. We're going to talk about potential solutions about that later on. But it's also around credit, whether I'm overextended, whether I've had challenged credit, or I'm just trying to establish credit maybe. And all those things can be potential obstacles for first-time home buyers. So in our classes, we love to talk about credit because we want to help solve for some of those issues, or at least provide you some tips and resources to help improve credit. So let's talk about what's, first of all, made up in the credit model. And by the way, I do know many of you joining tonight's class have some type of monitoring system, whether it's through Credit Karma, TransUnion, Experian, Equifax, whatever that might be. I want to dive a little deeper, though, and kind of show you what the score calculation looks like and the weighting of the score calculation. So 15% is going to be how long I've had credit. So the longer my credit profile is, the better my credit score is going to be. The next section is going to be how much new credit am I trying to access? That can be through hard inquiries or just opening new accounts. Now, that's 20% of the weighting. Now, hard inquiries you want to be careful with because those can impact your score. Now, in our process, how we start pre-approving clients, we only start with a soft credit score, which does not impact a score. But if you work with a lender or any other institution that has to do a hard inquiry, if it's mortgage or auto related, you have a 30-day window of time to shop around with as many lenders as you want. And that inquiries that you have in that 30-day window, it's the equivalent of one hit to your score. 30% is going to be how much credit do I owe on my revolving balances. Okay, so when we think about utilization of credit, that's what we're talking about here. So if I have $10,000 in credit limits, $5,000 in credit balances, that means I'm at 50% utilization. Rule of thumb here is I want to try to really get my utilization below 10%. So if you're maybe right around that 70 or 80% mark because you just charged maybe a vacation or back to school shopping, whatever it might be, try to really work to bring that utilization below 50%. Once we've gotten there, then let's try to chop that balance down to get below 10% utilization. Let me give you a quick tip on how to better manage utilization. So as a homework assignment tonight, if you have time, which you probably won't tonight, but maybe tomorrow night, take a look at your billing statement for your credit card. There's a cycle date or billing statement cycle date. There's also a due date, right? Many of us are in the habit of paying on our due date. However, the billing cycle date is the date at which the creditor sends out your data to the credit bureaus, and it reports how you paid, what your balance was, and that reporting can affect your utilization. So if I can get in the habit, change it up a little bit, instead of paying on the due date, pay before my billing cycle date, then I have a much better credit score and hopefully improve that score. So I'm improving my options when it comes to home buying. And then finally, payment history is the last weighting, and it's 35%. It's the biggest one. And it's pretty simple. Have I paid my bills on time? And ratings on those bills are based upon 30-day lates, 60-day lates, and 90-day lates. Now, if you've had a past challenge like a late payment, it's going to hit you the most on the score within the most recent 12 to 24 months of the date of the last event of that reporting. So just something to kind of keep in mind. But this is kind of what the FICO score calculation looks like. Now, there's different minimum credit scores for each loan program. So for an FHA loan, I have to have a minimum score of 580. For a conventional loan, it's 620. And for my VA loan, so if I'm a veteran that served and I have my eligibility, then it's a 620 minimum credit score. Now, when we look at the credit scores, we always look at all three of them. So there's three agencies, right? There's Equifax, Experian, and TransUnion. When we look at all three scores, we take the middle score of all three. So if I'm at 760, my middle score is 740, my lowest score is 720, the 740 score is going to be what we use for qualifying purposes. Now, if I want to apply with my partner, but maybe my partner has a little lesser credit, they're at 700, 680, and 660. Now their middle score is 680 as opposed to my 740. The 680 score is actually going to be the score that we're going to use for qualifying purposes. And I think that's really important to understand because that lower credit score could impact my interest rate, can also impact my eligibility for my loan product, and also mortgage insurance, which we're going to talk about in just a few minutes. Now, last thing I want to just mention, and we're going to switch screens here, account closure. And if you close out an account, you want to be careful with that because, you know, some of us get in the habit of balance transferring, which is totally fine, but you got to be careful that the account that you balance transfer out of, we don't want to necessarily close that account because that might be one of our most established accounts. And by closing that out, you impact the 15% length of credit potentially. And if I have less accounts available with my available credit, then I can also improve or hurt the utilization of credit. Now, if you've had some past challenges on credit, we want to provide you this matrix to show you how long those past challenges will remain on your credit. So the hard inquiries, while they're not challenges per se, they do have an impact to your score. So those inquiries in the most recent 12 to 24 months are going to be the most impactful, but those inquiries should only stay on your report for 2 years or less. Okay, let's talk about student loans. You know, and student loans are just, you know, something that's just the reality of, you know, qualifying for a mortgage. Most of our clients, since we do partner with many universities across the country, probably do have student loans. And I do realize that those student loans are going to be coming back into repayment in September or October. But in doing so, we do have to count a minimum payment for our clients in qualifying. So we have to take a look at those balances that appear on the credit report and apply a minimum payment. So if you're in an income-based repayment program, we can use that amount. If you're not, because let's say you graduated during the pandemic, and you haven't even started repayment until maybe September or October, then we're going to have to either take 1% of the total balance for the minimum payment for a conventional loan, 0.5% for an FHA loan. So here's what that looks like. So if we look at our screen here, let's say I have $75,000 in student loan debt, right? Now, if I'm on an income-based repayment amount, let's say it's $250 per month, that's the amount we'll qualify you with when it comes to your obligations. But if you haven't never been on an income-based repayment amount just because the timing didn't work, then like I said, you would have that 1% for a conventional loan. So let's say, it's $750 for that same account balance, or it would be $375 for an FHA loan. Now, of course, we're in forbearance right now because of the CARES Act as part of the pandemic. So we'll be going back online with payments. I do know there's talk of forgiveness of student loan debt. If that does come about and those balances, because we've had some clients that have had balances forgiven, then whenever those balances do get removed, that reduces the amount of debt, and that'll be less obligation for our clients to qualify with. Now, if you're doing some post-grad work and your counts are deferred because of that, we still have to count a minimum payment for you in qualifying. So those are things we'll walk through as part of a consultation with you. But I think during our class, it's always kind of helpful to understand, like, what's the eligibility going to look like when it comes to student loans? Because it does impact so many borrowers that we work with on a daily basis. Let's talk about loan programs. There's a plethora of programs out there, but I want to kind of talk tonight about 5 core programs that are available to us as first-time buyers or even second or third-time buyers. So I'm going to give you kind of a little bit of a snapshot of what characteristics look like for each one of these programs, and kind of see how they could apply to helping you on your journey towards home ownership. So the first thing is a conventional loan. The conventional loan has a minimum down payment of 3%. And in the Riverside market, that loan amount goes all the way up to a $726,200. That's called the conforming limit amount. Now, if you're joining us and you're in LA County, for example, the maximum loan amount actually goes up to $1,089,300, but that minimum down payment changes just slightly. So once you go beyond $726,200, the minimum down payment jumps from 3% to 5%. And the reason for that is because that's called a high balance loan. So just something to kind of keep in mind. Fannie Mae and Freddie Mac have designated high balance or high cost areas across the country. If you happen to go to the San Francisco Bay Area, same kind of loan amount, right? $1,089,300. And then San Diego or Orange County has similar high balance amounts. Even in Sacramento, we have high balance amounts up here as well too. So conventional loans, if you remember from earlier, has a minimum credit score of 620. All right, now we have an FHA loan. So FHA loans not designed just for first-time buyers. You can be a second or third-time buyer with FHA. Minimum down payment of 3.5%. We follow the same conforming limit up to $726,200, but something a little bit different. If I'm again going to buy in LA County, I can go into the high balance loan space. My down payment still remains at 3.5%. So only on a conventional loan am I going to jump from 3% down payment to 5% down payment. FHA, when we think about FHA, a little more leniency from underwriting guidelines. Credit score minimums go down to 580. So, a lot of times when we work with clients and kind of designing their home buying plan, we may have to go to FHA just for a little bit more leniency from a guidelines perspective. So let's say I forgot to pay my student loan payment 6 months ago and it gave me a 30-day late, right? FHA would probably be okay with that, but conventional loans, a little bit more restrictive. They really want to see a clean history of credit within the last 12 to 24 months, and of course, a little bit higher credit score requirements. Now, VA loans for our veterans have served, that's a 0 down payment option, which is awesome for our veterans. 620 minimum credit score, also has some good leniency in the guidelines. We allow a little bit higher, what we call debt to income ratio, which you're going to learn about later on, and some more flexibility in the overall guidelines. Loan amounts can exceed $1 million, which is super helpful for our veterans, especially buying in high cost of living markets. USDA loans are going to be for clients that really want to buy in more rural areas. Let's say I want to buy out in Joshua Tree, right? You could have a 0% down payment option with USDA. USDA, just like you would think, it stands for the United States Department of Agriculture. There's 2 big qualifiers for USDA loans: geography, so where I'm going to buy, and then there's income limits based upon my household size. And then there's jumbo loans, and jumbo loans aren't typical for our first-time buyers, but it's going to be for a buyer that needs a little bit more in loan financing than the conforming or high balance loan limit. Now, jumbo loans have a minimum down payment of anywhere between maybe 10 to 15%. So that's not always super achievable for most of our first-time buyers, but there's also another added layer of asset requirement with jumbo loans. Not only do I have to save up for my down payment and my closing costs, but I also have to save up for a thing called reserves. And reserves are assets that I have left behind after I've contributed my down payment and closing costs. Reserves can be anywhere between 12 to 24 months of a monthly payment. So if I have a $6,000 mortgage payment, 12 months of 6,000 is going to be $72,000. So I have to have those additional assets available to me after I've contributed the down payment and closing costs. Again, not very typical for our first-time buyers, but I want you to understand that there is options for those that are looking to purchase at a maybe a little higher level. Now, one of the things that comes up in home buying is what we call private mortgage insurance. And PMI, also known as private mortgage insurance, comes into play when I put less than 20% down. Let's talk a little bit about conventional PMI and what that means for us as buyers. So I put less than 20% down. It is going to add that additional payment, but I have to tell you, though, it's not as significant in the overall monthly budget as you might think. So if you're doing some searches on Redfin or Zillow, you're probably seeing some pretty high numbers with mortgage insurance. The reason for that is because mortgage insurance is calibrated a lot differently than what you're going to see on some of the websites for general searches. There's also different ways that you can pay mortgage insurance. It can be paid monthly. You can split some of it up into a monthly basis as well as upfront. You can buy it out completely. That's called basically paid upfront paid mortgage insurance. There's also lender paid mortgage insurance where you can add that into your amount finance, or not your financing, but you can actually put it into your interest rate offering. So instead of maybe a 7% rate, maybe I decide to take a 7.5% rate. That's a way to buy out mortgage insurance. But the most popular way is monthly mortgage insurance. And monthly mortgage insurance is going to be included into your monthly payment. And mortgage insurance is calculated as such. So it's based on your down payment, how much you finance, and then what your credit score is. So it's really important to understand that, because for our clients that are higher credit score customers and maybe putting a little bit more money down, the mortgage insurance is not as penalizing as you might think. Let's take a look at a quick example here in the bottom of the screen. So if I financed $450,000 and I put the minimum down of 3% and I had a 740 credit score, my premium is going to be about $183 a month. So probably a lot less than you're going to see when you do some of your searches or use different online calculators. That's because of where my credit score is at and my down payment. So really makes mortgage insurance a lot more affordable than you might think. Now, another characteristic of conventional mortgage insurance is that it has a cancellation option. So once I reach 2 years in my home and 22% equity, I can apply to have that mortgage insurance canceled. So that's conventional mortgage insurance. Let's talk about the FHA loan. Now, whether I put 3.5% down or I put 15% down, I will have mortgage insurance, or 20%, I should say. You're going to have mortgage insurance on FHA. And FHA doesn't have the same variation in premium based upon those credit scores and down payment and amount finance. It's pretty well set here, is that if I put 3.5% down, my factor is going to be 0.55% of my loan amount divided by 12, and that's what I pay for my monthly premium. There's also upfront mortgage insurance with FHA loans. It's 1.75% of my loan amount, and that gets added into my total loan balance. And then I, of course, will pay that back over time through my loan. FHA loans, however, do not have a cancellation option like conventional loans. So in order for me to get rid of mortgage insurance on an FHA loan, I'm probably gonna have to wait to refinance out of that loan and then maybe move to a conventional product, which is not uncommon. I kind of think about the FHA loan as my opportunity to get into my home, maybe do some regrouping, whether it's credit-wise or maybe it's assets that I need to save. And then as I get myself into home ownership, maybe I'm looking at some point to move to the conventional loan product. Now, FHA made a few changes 3 months ago, maybe longer, that lowered the cost of mortgage insurance. So this premium here of 0.55 used to be 0.85. So that makes it a lot more affordable for our buyers. So let's look at what a scenario now looks like for FHA. So we take that same $450 loan amount. We have our upfront mortgage insurance, which from a dollars perspective now is $78.75. And then the monthly amount is $206.25. So this $78.75 gets added into the amount finance. So now I'm financing basically $457,875. And then, I have my monthly premium. So, when you step back for a second, you may kind of wonder, why would I ever go with FHA versus conventional? Because it just seems, Jason, like it's a little bit more expensive. And you're right, FHA mortgage insurance will be more expensive. However, as I mentioned with the guidelines, there's a little more leniency with FHA from maybe past challenges that we've had, or maybe I just need a little more financing that maybe my debt to income ratio needs to be supported through FHA. So there's a variety of different reasons why I might choose FHA over conventional, but it's really our job to kind of design options that make the most sense for you and help you obviously achieve the goals and objectives of homeownership. Now, let's talk a little bit about documentation when it comes to income. So income is, one of those things that we have to look at to verify that, your income can support the budget that you're looking to achieve with homeownership. And there's a little bit of documentation that needs to be requested. Usually it's the last 2 years of W-2s, 30 days of pay stubs. And then we're going to verify the employment either through online verification, phone, or some type of written verification. Now, if I'm self-employed, it's going to look a little bit different because I do need to verify 2 years of tax returns, as well as a P&L and probably a balance sheet. And then we'll verify the business in some way, shape, or form. Usually a CPA letter is a good verification method. Now, there's a few misconceptions around income that I think it's important to address in our class. And a couple things, in fact, I was talking to a client about it earlier today when it comes to work history. So you don't necessarily have to have 2 years on your job to qualify for a mortgage. As long as you've had job history and or education that equates to 2 years, you can get qualified for your mortgage. So let's say, for example, I just graduated from Riverside in the fall. I started with my firm in February, and I've only been there for 6 months. I can still get financing because I can show my undergrad work at Riverside coupled with my new work. So that would give me my 2-year requirement met. So that's one thing to think about. Other scenarios that we hear from clients is that, do I have to wait to transfer jobs? So maybe I got a new job offering. Can I still get qualified for a mortgage? And the answer is absolutely yes. As long as we have an unconditional offer letter, we can use that offer letter to help you qualify for your mortgage. And then we have to just verify your start date for your upcoming job. Now, where it gets a little tricky is some of our clients do have dual jobs. We see this a lot in the healthcare industry where, let's say I'm working for one clinic for maybe 20 hours a week, another clinic for 30 hours a week. I do have to verify that I've been on both jobs for 2 years in order to be able to qualify with both sources of income. So just something to kind of keep in mind. If I have, let's say, a side job, right? Let's say I work for one organization for 40 hours a week, but I also drive for Uber. And if I want to include the Uber income, because it is 1099 Schedule C income, I'm probably going to have to make sure that I have at least 2 years between working full-time as well as doing my side job. Okay. Now, when you qualify for a mortgage, if you do have other household income that you want to include it into the qualifying, let's say I make X amount of dollars and my partner also makes a certain amount of money. If I want my partner's income to be included into the calculation, I have to have a joint application with me and my partner. Otherwise, that income can't be included. Okay. So those are some of the things that come up in home buying as it relates to income. Now, I want to talk about another aspect of income, and that's our expenses versus income. And that's also known as debt to income ratio. Debt to income ratio is a measurement that we use in lending that determines our obligations versus our income. And we look at gross monthly income for our W-2 wage earners, net income for self-employed individuals. Usually we don't want obligations to be more than 43 to 45% of that gross monthly income. Here's what the calculation looks like. So we take your new house payment, principal and interest, property taxes, homeowners insurance. Now, if I put less than 20% down, remember I have private mortgage insurance, and then we look at an HOA expense. So if I maybe buy a condo or a townhouse, I probably have an HOA expense. So that all gets factored in, as well as my other debts, personal loans, credit cards, student loans, all that stuff gets factored in versus my gross monthly income. So here's a good scenario here. If I have $3,000 in debts, $8,500 in monthly income that's coming in, my debt to income ratio is probably going to be about 35%, right? Now, again, that's a measurement for qualifying, doesn't indicate affordability. And I think that's a bigger question that we have to solve for, right? Our two big goals with homeownership is affordability, and then we want to make sure it's sustainable. I was just telling a buyer that just about 2 hours ago, because we want to make sure that you can feel good about your home purchase, right? And make sure that you can do it for the long term, not just buy a house, get excited for a year, and then all of a sudden it just doesn't work out, right? So the debt to income ratio will help us from a qualifying perspective, won't necessarily indicate what affordability looks like, but we'll have that conversation with you. So the last component to qualifying for your mortgage and building a home buying plan is assets. How much do I have saved that I can contribute to my home purchase? And we understand, especially as first-time buyers, that we probably don't have a lot saved right now, and that's totally okay. But we're going to ask for just what income or what assets we do have proof of now, and there's documentation around that. Usually, we need the last 2 years of statements for you, for maybe checking and savings account or maybe a money market, brokerage accounts, whatever you decide you're going to use towards your home purchase. Now, you may want to use 401ks, 403bs, even an IRA account. I would encourage you to talk to your tax advisor, maybe your financial advisor, make sure that's a tool that you want to use towards your home purchase, because we don't want to create any like tax implications for you. Now, gift funds can be potentially used, and that's where I have a family member that's going to contribute funds to my home purchase. There's a whole documentation process to that, usually includes like a gift letter, and then we have to show the transfer of the funds. But with gift funds, they don't have any type of seasoning requirement. Whereas if I'm going to use my own assets, I have to have those assets seasoned at least 60 days. Now, if you recall, when we were jumping into our credit section, we talked about the 2 challenges for first-time buyers, right? Credit, maybe because I'm overextended, or I'm just trying to keep up with my monthly obligations. But more often, it's going to be savings for my home purchase. And we're really proud to be a leader in first-time buyer, not only education, but first-time buyer assistance programs across the state. We partner with CalHFA, which is the California Housing Finance Agency, and their mission is to help low and moderate income households achieve homeownership. So every class that we teach, we always dive into these assistance programs, and there's a lot of great tools that are out there for you as first-time buyers. And so I want to talk to you a little bit about programs that are available today, give you kind of a hint or a glimpse into what's coming ahead, hopefully in 2024, and see how those can be resources that can help you on that path towards homeownership. So the first program is the MyHome Assistance Program. So if we remember from our product section tonight, the minimum down payment is 3% for a conventional loan, 3.5% for an FHA loan. The MyHome Assistance Program will help fill the void when it comes to your down payment needed for your home purchase. And what this is, it's a low interest rate assistance loan at 1% simple interest, does not need to be paid back until you either decide to sell the home or if you decide to refinance in the future. So that can help solve for my down payment challenges. Now, when we purchase a home, it's not just down payment, right? It's also closing costs. And so there's another program also offered by CalHFA called the ZIP Assistance Program that provides 2 to 3% of your loan amount in closing cost assistance. In today's market, it's not used often because where interest rates are at, the ZIP Assistance Program really elevates the interest rate on the first mortgage pretty dramatically. So we encourage our buyers, if at all possible, we want to try to save up at least the closing costs so we don't have to lean on the ZIP Assistance Program. We can just use the MyHome, which is going to help cover that down payment minimum for you. Let me show you what an example looks like if we were to buy a house using the conventional CalHFA product. So if I purchased at $450,000, I know I have a minimum down payment of 3%, which is $13,500, but then I also have closing costs that are 2 to 3% of my sales price estimated. So if I was to not use an assistance program, I at least need to save up about $22,000 to $27,000, right? Not always attainable for most of our first-time buyers. We understand that. I think on average, most of our first-time buyers have about $10,000 to $12,000 available to them, excluding gift funds. Now, if we were to take that same scenario and now overlay some maybe MyHome Assistance, we can have that $13,500 covered through the MyHome Assistance Program. And so now that takes one expense off the table. Then I only have to worry about my closing costs. So if those are $8,000 to $13,000, maybe that's a little bit more manageable for us. And if I really need the ZIP assistance support, we could take advantage of that as well. So why I share that with you is because, homeownership for many of us sounds like it's a long-term goal. It seems like it's a 3 or 5 year goal. But I think when you really sit down and look at options offered through CalHFA, it can really make it a 6 to 12 month goal for many of our buyers. Now, there are eligibility requirements for CalHFA. There's a minimum score of 640 for an FHA loan, 680 for a conventional loan. The debt to income ratio that we just learned about, maximum of 50%. There is income limits, but those income limits are based upon the applicants that apply for the mortgage. not the household income. So when we think about that, if I was to buy in, let's say, Riverside County, and I make 100,000 and my spouse also makes 100,000, well, combined 200,000, we may make more than the income limit. But if I'm just applying in just my name, then my income is the only income that's going to be used for qualifying purposes. Now, a first-time buyer, believe it or not, is someone that hasn't owned in the last 3 years. So if you owned a house back in 2012 and you sold it, you've been renting ever since, you're still a first-time buyer. Now, this program is available for many different types of properties: single-family homes, condos, townhouses, even manufactured homes, but manufactured homes have to be on land that is owned. Okay. Here's the income limits for some of our Southern California markets that we serve. So these income limits are based upon about 150% of the median income for those markets. And with CalHFA, they're very lenient from an income limit perspective. Most first-time buyer programs, especially in your local city products, are going to be maxed at 80% of the median income. So it just gives more inclusive opportunities for many of our communities. And one of the things I want to share with you, what's coming down the path here in 2024, and you may have heard about it, it's called the California Dream for All program. We were able to deliver that product to many clients earlier this year in 2023. Well, there's another allocation of funds coming from the state general fund of $200 million. We're still working on some of the program guidelines behind the scenes, but hopefully that product will be available sometime in 2024. So if that's something you're interested in, or if you've heard a little bit about this program, it is getting revamped right now, but we should hopefully have it available next year. Stay tuned for more details on that. You can always follow us on our social channels for updates, as well as we'll be hosting a live Q&A on YouTube as we get more information. So that's part of the CalHFA suite of products. Now, I want to now take us through the process of buying a house. This is called our 6 steps of home buying. So after we've attended tonight's class, we may get really excited about, okay, what's next for me? Well, the next step would be doing a consultation with us to design a home buying plan for us. The output of that consultation is to be pre-approved. And a pre-approval is a certificate that we get as a buyer that we can use to start this journey towards homeownership. So if I decide to present an offer to a seller, they can see that I'm fully ready with my financing. That pre-approval is usually good for 60 days, but it can always be updated or recertified at any time. And then we can, because the markets are always changing, whether from a sales price perspective or an interest rate standpoint. So we want to make sure that your profile is always fully updated. So pre-approval will start this journey, right? Step 2 is going to be the home search. And many times it's going to start online through your Zillow or your Redfin, and your realtors will help you with navigating the online search and maybe set you up on like a portal for your search. You can filter out things that work for you or don't. Now, realtors, as you heard earlier, are paid for by the seller. So we always encourage you, take advantage of that resource if you can. We also have preferred realtors that we work with across the country. They can help you in your local markets with whatever your need is. But realtors will help not only find the home for you, negotiate your price, help with timelines, organize inspections for your property. They're going to be an instrumental part in this buying journey. So now let's assume we've made an offer on a house. So we make our first offer, and guess what? It gets accepted. And right now, that's kind of half the battle, is just getting an accepted offer. Now, when that offer gets accepted, within 24 hours, you're going to hear from our team. We're going to reach out to you, say, congratulations, you got your offer accepted. Now here's what to expect next. And what next is, we're going to schedule you for a follow-up video consultation to talk a little bit about your contract, timelines, out-of-pocket expense, what your monthly payment's going to look like, all of those really important ingredients to your home buying. And then you're also going to be required to make what we call an earnest money deposit. And that usually happens in the first 2 to 3 days of your contract period. Usually an earnest money deposit is 1 to 2% of your sales price. And that is a good faith deposit you're making. It's showing the seller that you have a financial interest really in this property, right? And then within 72 hours of your contract, we're going to be sending you your initial disclosures that highlight your interest rate, your payment, your cash out of pocket, maybe some of your assistance programs that you're going to elect. All of that stuff will be part of your disclosure package. You heard me mention about earnest money deposits. It's usually 1 to 2% of our sales price. And what that is, it's a good faith deposit that gets contributed, but the seller doesn't get access to those funds quite yet, because those funds are held in escrow because you're allowed to do a little bit more research on this property before that deposit becomes accessible to the sellers. And it's called a contingency. It's usually in the first 7 days to 17 days of your contract period. In today's market, we really have to kind of shrink down contingencies because it's such a competitive market. Sellers want to know that they're going to be able to really sell their home in case the buyer discovers something that's maybe a challenge. The contingencies are usually in 3 areas. Appraisal, we want to make sure the house appraises what we're going to pay for the home. The loan approval contingency, making sure we have our financing all cleared. And then the inspection contingency, which your realtor will help orchestrate that. And that, you're going to get a home inspection to kind of check out what's going on with the house, right? And so you're protected and your deposit is protected while you're in that contingency period. So if something kind of creeps up and you're like not feeling comfortable about it, you can potentially cancel that transaction. Now, step 4 is going to be processing and underwriting. That's where we do all the administrative tasks of the loan, verify your employment, documentation that you provided, make sure that all checks out. Probably by that time, we're going to have your interest rate all locked in, given the state of the market, and you'll know all about that. And we're going to have everything kind of packaged, structured, ready to go, because the next step is going to be the underwriting review and the approval of your loan at step 5. So actually an underwriter looks at everything, your credit, your income, your assets, the property, all of that stuff gets checked out, and then a loan approval is issued. Now, at that time, at step 5, we're probably 3/4 of the way through the process. So if you're comfortable with the due diligence or homework you've done on your property between your loan approval, inspections, and appraisal, you can remove that contingency. Now, just be mindful, though, that once you remove contingency, you're kind of all in on the purchase. So if you decide to cancel, you could potentially lose your deposit. So you want to make sure you feel really good about the property. At step 5, we're also going to issue to you a final closing disclosure. And that gives you a 3-day cooling off period to make sure you feel good about your financing and all the costs that you have in this home before you get to the final stage. And that's called closing the loan. So that's when you get a chance to sit down and you sign physical documents in person with a public notary. Now, it's important to note that all the documents that you sign leading up to this point are all done usually with an e-doc or DocuSign type of situation. So, but step 6 is still a little bit old school. We do the, handwritten signatures in front of a public notary. That process will take about an hour or so. Once you're done with that, then you wire in your final funds that you have owed for your home purchase. And then any assistance programs that we elect or whatnot will be all funded through your mortgage. And that's the next step in the process, or next step as part of step 6, is that we're going to wire in the funds for the mortgage. Those funds get reconciled by an escrow team to make sure that you're contributing what you're supposed to as a buyer and the seller's receiving what they expect. Once those monies get all balanced out, then they're going to take and deliver documents to the local county recorder's office. They record a grant deed, which is the transfer of ownership to you. And they also record a deed of trust, which is your agreement to repay your loan. And so what will happen then is we'll get confirmation back that those items have been recorded. And then I get to do my most favorite thing in the day to do, which is call clients and say, guess what? You are now the official owner of the home. Now we've completed everything. Go get your keys, start moving in, because today's the day. And that's like the best part of my day. I got a chance to do that a couple of times earlier today. And I really look forward to that because, we understand going through a process of buying a home is going to be something that's going to be, a little bit, anxiety, a little nervousness, not know what to expect, what's around the corner. But it's our job to create a high-touch experience. So we're available for you, text, call, email, put you at ease through the process, because the finish line is step 6. And that's a day that we all get a chance to celebrate. So really cool opportunity there. Now, after attending tonight's class, you want to kind of learn a little bit more about what a home buying plan might look like for you, or maybe you have some questions about tonight's content. You can get connected to us in a variety of different reasons. We have an introductory call, which is a 10 to 15 minute call with me to do a one-on-one and talk a little bit more about your situation. If you're ready to dive in and kind of build your home buying plan, it's a really simple online application. You upload documents that are prompted for you in the application, and then we schedule you for either a video or phone consultation to go through your home buying plan. Well, that consultation looks a little bit like this. So it's going through a lot of what we talked tonight: budgeting, interest rate options, looking at your credit, how to optimize it, what are the programs that are right for me, what is my down payment going to look like, should I elect some assistance programs? And let's do a refresh of the process too. So where do I go from here if I get pre-approved during my consultation? So that's a free service we provide, whether you're going to buy next month, next year, maybe if it's a 3 or 4 year goal. We want to help educate you and make sure you have all the resources available to you. So when you want to make this big financial decision, you know what to expect and what's available to you. Now, we're not only a high touch team where we really try to provide a lot of support for our clients, but we also value technology. And our mobile app is a wonderful tool that will allow you to start the application process right from mobile. You can follow the progress of your loan. You can get updates. You can run calculations when you're looking at homes. Really encourage you to check out mobile, available, of course, for Android and iPhone as well, too. We're proud of all of our partnerships and the ability to be able to kind of share all this information with first-time buyers like yourself. And we have other partnerships across the country that we're proud of. If you have friends, family, maybe some coworkers that you think might enjoy a workshop like this, or maybe they're affiliated with some of these partnerships, we would encourage them to come check out some of these classes. You can find our full list of class schedules at mortgageeducate.com. We also house all of our recorded, and we'll have live versions on our YouTube channel, which is just simply at JMada Mortgage. And as I wrap up tonight's class, I want to spotlight our closing cost discount for our UC Riverside alums. So by partnering with us in this journey towards homeownership, you get $750 off of your closing costs, which is an awesome benefit. Of course, access to all of our programs and all our services that we provide to our local communities. So with that said, I do want to thank you again for joining tonight's class, spending some time with us on a busy Thursday night. And I'm going to go ahead and open it up for questions in case we do have anything. I know we didn't have a lot going through the chat this evening, but I want to stick around for a couple more minutes. We're almost up to the top of the hour, but want to make sure we answer any questions that you might have. And otherwise, we'll wrap up. So let me just keep it open for a little bit for some Q&A here if we have anything. I don't see anything in the chat yet, which is totally okay. If you do have some questions and maybe you just don't want to ask them on air, feel free to reach out to me. I'm always available. You can message me, you can send me an email, call, whatever works good for you. We just want to make sure you're getting all the right answers you need. And as we go ahead and kind of wrap up tonight, this market is an ever-changing market. So I think it's really important to stay connected with us. We have a lot of great resources that are available to our first-time buyers. And we try to post a lot of great content on our social channels. So if you get a chance, try to follow us at Instagram at JMada Mortgage, especially if you're interested in some of the first-time buyer programs. That's what a lot of our content is directed towards, like what's going on with CalHFA and some of the assistance programs that are either rolling out or set to roll out or that are accessible right now. So, I encourage you to kind of follow us there. We also have some amazing reviews from some of our clients, many of which have attended workshops just like you're joining tonight. So, we'd encourage you to kind of check out what our clients are saying about us. So, and this is our link again to schedule any type of appointments with us. So, that being said, thanks again for joining us in tonight's class. I think we're good on our questions. So I'm going to go ahead and sign off, and hopefully we'll get a chance to connect with you all soon. Have a good night.